It's been kind of the tale of two different equity markets this year. In the first half, we saw a lot of volatility around the Liberation Day in April. We saw a very big correction in the equity market, not only for that to surge back, but we finished the third quarter making a record high, and we've continued to repeatedly make record high in equities. The euphoria around the Fed cutting interest rates and the AI boom, in our opinion, is just getting very overstretched and very overdone. This is a momentum trade now. This is not necessarily running on earnings or valuations. We do think that earnings over the next couple of years will continue to move higher, but the optimism around the growth rate is simply too high. When you look at PE valuations, there's not much catalyst to see that valuations can move much higher from here. We're hovering near levels that we've seen in past periods where we have experienced bubble-like characteristics. If you look at this chart, not only is the U.S. market, from the growth perspective, the value, even all the way down to the mid-cap space, the mid-cap stocks, they're all trading at premiums to their historical average. It's very hard to justify buying something at a significant premium, especially when you're looking at a weakening economic economy and inflation that simply won't go away. So be prepared that the volatility environment may be a bit more intense as we get into the remainder of this year. So what would we recommend for our equity investors? First of all, if you are heavily weighted in technology, Mag 7, growth names, reduce that exposure. This is not an environment, especially if the Fed can't live up to those heightened expectations of cutting interest rates, that you want to be in those stocks. Some allocation is fine, but having an overweight to those areas is not something we can justify at this time. Take a look at making sure you're diversified in the market cap level, but you want to be careful with some of those. The value side of the market is also relatively expensive. Just make sure you have a little bit more exposure to value over growth. Small and mid caps, valuation-wise, are cheaper. So you should make sure you have some diversification in those areas, but be careful of the growth side of that area of that market as well, because those valuations have run up along with the U.S. large cap space. We continue to like the developed international markets, but we're getting a little bit concerned here through year end because they have had such a robust rally. Their earnings are good, but not great. And we think that there has been quite a bit of rotation into that area. So if you have none, yes, add a little bit of exposure into the developed internationals, but be careful at these levels jumping all in. As we showed you, those valuations are expensive right now as well. We'll continue to assess what we think will be a volatile year-end and even into the first quarter of next year. We'll look at opportunities for the long run because we still do like equities long run. We're still very constructive on the economy in the long run, but right now, the prices you're seeing in the market are fully reflecting the Fed cutting interest rates up to 5 times next year. We do not think that that's possible. The valuations are extremely stretched in a historical standpoint, looking like some areas are bubble-like. It's an environment you want to take some of those chips off the table. If you need to rebalance your portfolios. Make sure that the market hasn't run up your allocation too much, that you're more overweight than you thought you were. Make sure that you look at that as well. That's what we'll be doing into the year end.
4 minutes.